Welcome to WWC Consultant Athletic Footwear. So, our team member for this company, my name is Amar Sumaina, the CEO.
Hi, I'm Damien Lopez, the COO.
My name is Zain Fadil. I'm the CMO.
I'm Rashid Cameron, the CPO.
Luis de la Cruz, CFO.
Our mission is to provide high quality, innovative, and performance driven athletic footwear. And we commit to have a sustainability by utilizing eco friendly material. Through technology advancement, we aim to develop durable and recyclable products. And we keep dedicated to operational efficiency, customer satisfaction. Our vision is to become a globally recognized leader by continuous innovating, expanding into emerging markets, and delivering expansion products that inspiring while empowering every athlete and active lifestyle to reach their full potential. Our core values, delivering our vision that support your active lifestyle without compromising on comfort, style, or the planet. Our product line, we are specialized in manufacturing and distributing athletic footwear and running shoes designed for performance, training, and gym shoes with engineering stability support during high-intensive workout, casual and lifestyle sneakers, blending style with functionality for everyday wear, and of course, for support specific footwear like basketball, soccer, and football, we have, of course, specific performance enhancement. And last but not least, we offer customization service, allow customer to personalize their footwear choices. Our target market, we aim by offering both branded and private label footwear at low price than its competitors, while utilizing our current two facilities in North America and Europe. We're aiming to penetrate and expand into Asia-Pacific and Latin America, leveraging its cost advantage to gain market share in a price-conscious region.
Looking at WW Consultant's current strategic positioning, we need to understand its strategy. Our company's business strategy is to implement a mid-cost leadership while reducing operational costs. Our strategy is to lead the global footwear market by delivering high-quality, stylish products that meet the diverse needs of our customers. Continuing to expand our brand presence by utilizing the optimization of cost efficiencies, differentiating ourselves with cutting-edge designs and exceptional customer service. We'll do this by focusing on innovation, customer satisfaction, and sustainability. Using these aspects, we will solidify our market leadership and maintain a competitive edge in an ever-changing global marketplace. The first 2 years of our strategic goal out of the 3-year strategy went according to plan, while the last year our production output lowered, increasing our price and SQ rating. Looking at our competitor analysis. Who are our competitors? Our competitors are Aries Unleashed, Be Fast, and C Company. Aries Unleashed is a successful company that has a hold on the market above where WWC conducts business, while Be Fast occupies the high production and mid-price market segment. C Company employs a high production and medium price range market as well. This makes Be Fast and C Company WWC's direct competitors that implement a similar strategy with a high production rate and low SQ rating. WWC competes in the market in the lower right segment with high production and low price. Looking at the prices of our products, you will see the two different segments that WWC competed in. Those segments are the internet segment and the wholesale segment. As you can see in the internet segment, in year 14, WWC is at the mid price of the highest sold shoes in the market. In year 15, we were strategically in the middle of pricing in the internet market, but we see an uptick in price in year 16. This is due to our manufacturing issues in Europe and Africa that our production facilities did not produce, decreasing our production, thus increasing our prices. You can see the same thing happen in our wholesale market, where we were in the middle for 14 and 15, and then 16 we see that jump. Looking at our market share, we can see that throughout the years 14, 15, and 16, we had a decrease in market share. We had the most market share in the internet market in year 14 with over 35%, with a steep decline to a little bit above 10% in year 16. We see the same thing happen in our wholesale market, where year 14 we start out with 25% market share, and in year 15 we are again just above 10%. These next graphs show a different story to our market share holdings. As you can see, if I can take your attention to the top left, we're looking at our wholesale market. You can see we have a quarter of the market to us. It reduces itself to 18% and again to 11% in year 16. Bringing you down to the bottom right of these graphs, we see internet market segment in year 14 with us holding 37%, down to 25%, and again down to 12%. What this shows us as the management team is changes need to be made to increase our market share and decrease our price back to where we want it.
Our sales promotion and sales promotion initiatives in the wholesale segments involved rebates and clearance sales. The internet segment saw a rise in investment in marketing as the search engine advertising and sex appeals of celebrities increased sales. However, in terms of advertising, spending competitors spend more than us, but due to focus on the internet advertising, we were very close to them. Advertising and endorsement will continue to be major promotional initiatives since it would enable the firm to create appeals for specific customer segments. These tactics are also anticipated to help the company establish its market dominance and have more effective competitive advantage, notably in the internet segment. In the last 3 years, CSR development has increased by 6% annually, and our primary goals include acting sustainably and ethically. Even though competitors spend much more on CSR, the focus on environmental issues and social causes has been effective in brand perceptions. Customer awareness and appreciation for sustainability have risen tremendously. Thus, boosting our image in the future, we are committed to augmenting our sustainability efforts to enhance our CSR position. Therefore, we expect to increase clients' loyalty and build consumers' recognition of our company as the environmentally friendly business. From year 14 to year 16, we increased the production capacity by 15% in North America and Europe and improving manufacturing. However, competitors can still produce goods and services cheaper and faster in Asia. Investments in European production have resulted in better operational outcomes that have enabled us to control costs better. In the future, production capacity in Asia Pacific region where costs are higher should be increased to improve the competition indicators. In the most line items at average industry level in all regions. NAM labor cost per below average on year 15 and year 16 by 5 and 2% respectively. In Asia, labor cost per pair below average in year 16 by 2%. In Latin America, labor cost per pair below average on year 14 by 4%. Worker productivity above average in all regions on year 15 and year 16 by 2 to 7%. And for overall improvement on year 16.
Here we have our financial management for WWC Consulting. In year 14 and 15, dividends were almost stable, but they declined in year 16 by 23%. Debt increased in year 15 by 25% and remained stable thereafter. Equity reduced by 18% in year 15 and 45% in year 16. Stock repurchase presented in year 16 worth of $1,770. As for our current financial health, EPS has improved by 10% in year 15, but declined by 75% in year 16. ROE improved by 33% in year 15, yet it declined by 70% in year 16. Stock price declined by 25% in year 15, followed by a 60% decline in year 16. This shows how our company started off well and fell off towards the middle and end of the simulation, which signifies us as management needing to make some changes to correct things. And that brings us to our SWOT analysis. Here's a quick snapshot of some strengths, weaknesses, and opportunities, also threats. So for strengths and opportunities, we're making a large number of sales in regions such as Latin America and Asia Pacific. Our revenue surpassed $1 billion, proving market relevance. In year 14, our company won the Corporate Social Responsibility Award. Debt to asset ratio is 0.38 and equity is $485 million. These values show financial stability. Continuing with our SWOT analysis, here are some weaknesses and threats. Competitors are outgaining us in markets such as Europe, Asia, and Asia Pacific. We are not meeting investors' expectations. We have a score of 29 in that department at the end of the simulation. No Europe and Africa facility restricts our market reach. Another threat is the United States economy and a possible imminent recession.
First, we want to expand production capacity by upgrading current facilities and exploring new regional hubs in Latin America, Europe, and Southeast Asia to meet rising global demand. Then we enhance private label and branded product lines through regional customization, improve supply chain responsiveness, and increase use of sustainable materials. And lastly, we plan to strengthen brand visibility by investing in data-driven digital marketing, influencer partnerships, and improve delivery infrastructure to boost customer engagement and retention. Funding requirements, we're estimated between 12 to 15 million needed over the next 18 to 24 months for facility expansion, technology upgrades, and marketing investments. Funding sources are going to be through reinvestment of retained earnings, strategic partnerships, potential short-term financing, and possible equity issuance. Capital allocation, we plan to do a breakdown between 40% for production upgrades, 30% for logistics and delivery infrastructure, 20% for marketing campaigns, and 10% for sustainability initiatives. For future financial health, on our pro forma projections, we're expected to grow 8 to 10% annually due to expanded capacity and digital marketing gains. For gross profit margin, we expect to improve from 15.9% to 18.2%, driven by cost control and economies of scale. On the net profit margin, we want to raise from 1.8% to 6.5% as capacity bottlenecks are resolved and marketing ROI improves. In regards to liquidity and debt position, current ratio should remain strong at 2 or 2.2, indicating healthy short-term financial health. Debt to equity ratio projected to stay under 0.45, maintaining conservative leverage even with expansion financing. And on the return metrics, our EPS is projected to rebound from 46 cents to $1.15. Future stock performance, stock recovery projected following production expansion and increased earnings, aiming to reverse year 19 EPS dip to 46 cents. Positive market perception expanded from continued investment in sustainability, digital transformation, and improvement of ROE, targeting 15%. Valuation growth potential as brand equity strengthens and private label margins improve.
With that, I would like to thank everybody for their time and attention today concerning WWC Consultant.
Thank you.
Thank you.
Thank you, everyone.
Thank you.